Recession fears are overblown, and Amazon is trading at an attractive price right now. Amazon stock is down almost 20% in the past month. A possible recession and increased capital expenditures make the stock more risky. Its valuation is at an all-time low and equivalent to a retail competitor. Let's dive in. Amazon stock analysis: should you buy Amazon? On the dip? Welcome to Timely Investment Research. When recording about Amazon before earnings, I rightly predicted that the stock could go down as much as 10% after earnings. But I didn't anticipate a full-blown global market crash. Amazon stock sank to a low of $154 at its worst, yet has since recovered to the $160 range. Other than the fact that investors were simply taking profits after a bull run, Amazon is facing two fundamental problems in its business. Most economists have debunked the fact that we are certain to enter into a recession. However, consumer spending is weakening, as I had warned. Second, Amazon is ramping up capital expenditure, which fundamentally lowers the value of the stock. Therefore, investors would be holding Amazon to a higher standard in growth. Analysts have since reiterated their ratings. However, out of the 54 Wall Street analysts, the price targets range from $164.37 to $229.20, still above its stock price as of recording. Consider lower consumer spending, increased capital expenditure, and its large recent stock decline. I believe that Amazon is trading at an attractive price right now, but I'm unsure if it has bottomed. Mixed second quarter 2024 results. Amazon Web Services was the star of second quarter fiscal year 2024, growing at 19% year-over-year to $26.38 billion, beating analyst expectations. Meanwhile, Microsoft's Azure lost 2 percentage points of market share as Amazon Web Services reclaims lost market share. Amazon's first-party online store growth slowed, growing only 4.6% year-over-year to $55.4 billion compared to the 7% year-over-year growth it saw in the previous quarter. This is due to weaker consumer spending. On a similar note, advertising revenue grew 20% year-over-year, which was lower growth than analysts' expectations, likely due to competitive pressures and reduced spending from advertisers. Customers are seeking lower prices. In second quarter fiscal year 2024's earnings call, management reported that its consumers are being cautious and that they are looking for deals. I previously noted this could have been seen through the greater use of buy now, pay later payment methods and customers comparing prices at other retailers during Prime Day. With consumers looking for deals, competition from discount Chinese-based e-commerce sites like Shein and Pinduoduo's Temu is picking up. Amazon has been able to defend its market share in previous quarters due to its selling of higher-priced products. But it will be harder to do when consumers are purposely seeking bargains. Amazon will attempt to mitigate this risk as it launches its own discount store this fall. However, Shein has niched down and become very popular with Gen Z women, while Temu's gamification strategies keep giving it a competitive edge. Amazon's strengths against weak macroeconomic conditions. Despite weak macro conditions, there are a few mitigations that should be mentioned. First, Amazon has successfully built up the infrastructure to profitably deliver goods at a rapid pace. This is a competitive advantage as during hard times, it could lower prices while still ensuring that packages are delivered swiftly. Second, Amazon has a relatively well-off demographic, with 57% of Amazon shoppers having a household income of greater than $75,000 per year and its most frequent customers having a household income of $90,200 per year. Capital expenditures will continue to increase. Increasing capital expenditures directly lowers the amount of free cash flow used to value Amazon. Of course, a good return on investment justifies the spending, but it's why Amazon would be held to a higher standard for growth in future quarters. Amazon's capital expenditures increased this quarter to $17.62 billion, returning to its highs. Other than investments in Amazon Web Services, Amazon is investing a substantial amount in satellites for its Project Kuiper, which provides broadband internet similar to that of SpaceX. Moreover, it still needs to invest substantially to add content to Prime Video to stay competitive, while investing to improve logistics and automate the warehouse. Though sentiment on big tech remains negative and recession fears are still prevalent, this increase in capital expenditures would likely be on top of mind for investors. And it would limit the stock's growth until revenue begins to rapidly pick up. Valuation appears to be cheap. There is now a huge discrepancy between Wall Street analysts' average price target of $201.99 compared to its stock price of $162.77. After its fall, its enterprise value earnings before interest, taxes, depreciation and amortization is just 15x, which is similar to that of a retail-heavy competitor like Walmart with an enterprise value earnings before interest, taxes, depreciation and amortization of 14.1x. This is considering the fact that Amazon has a high-margin cloud business with over a $100 billion annual run rate. Its valuation compared to Walmart certainly shows the prevailing negative sentiment against big tech. Of course, it's difficult to say when sentiment can change, and worse economic data could certainly present itself. I don't know where Amazon would bottom. But I think these prices today are attractive, and investors could potentially dollar-cost average in the meantime to maximize gains. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.